Hi, everyone. Welcome to the Deep Value Podcast. My guest today is ValueStockGeek. He's an anonymous blogger, and he runs a popular Substack and a popular Twitter account, which I've followed for some time now, and I've really enjoyed his tweets. And I reached out to him, and he agreed to be on the show. Value, thanks for coming on.
Thanks for having me.
I just wanted to start with your job right now is not in value investing. It's something you love to do on the side. And I was curious where that passion comes from. When did you first get the inkling that you were interested in value investing?
I got really interested in the market in high school, so that was in the late 1990s during the internet bubble. And I was very much into the internet, and I had a personal computer, and I was on the web all the time. And I very much got absorbed into that bubble with small amounts of money, like money I made mowing lawns and stuff. So my favorite stock at the time was Cisco, and I happened to graduate high school in 2000. And at my graduation party, a much older family friend recommended that I check out The Intelligent Investor. And it just happened to coincide with the peak of the internet bubble. And I sold out of Cisco, and after reading Ben Graham, it just resonated with me, the idea of Mr. Market. And the entire time it didn't sit right with me. It was kind of like I had some apprehensions about it, like this doesn't make a lot of sense. These companies don't make money. They're at these insane multiples. Mm-hmm. And I read Ben Graham, and it kind of opened my eyes. And then from there, I read the Buffett letters in college. And it immediately stuck with me, and it immediately made sense to me. You should try to figure out what something is worth and pay less for it.
Were you able to find value stocks back then? That was when I started investing too, and I struggled a bit.
Yeah, I struggled, but I found some investments back then. I remember one stock I bought, Smithfield Foods. That worked out okay. I don't remember a lot of what I was doing back then. A lot of it was almost like throwing darts at a board. But yeah, it resonated with me, and I thought that the philosophy made a lot of sense. And then there was also the confirmation bias of seeing the internet bubble fall apart and value be triumphant. So that converted me, in addition to the logical underpinnings of it all.
I was talking with Jake Taylor about this about a month ago. And we were both noting that it's very interesting that all these famous value investors, Guy Spear and Michael Burry, there's just a ton of people. Almost all of them happened to start in 2000 or really close to that, which happened to be basically potentially the best time in history to get into value investing. Value went on, its run from 2000 to 2007 was really a pretty historic run.
Yeah, and it just goes to show you the importance of getting in at the right time. I mean, there were probably guys just as talented and brilliant who started in maybe 1989 or 2012, and they just didn't have the same luck because value wasn't working at that point in time, and they weren't able to develop the fame and fortune. And I mean, you look at a lot of those guys; they've all pretty much struggled in the last decade that value hasn't worked as the factor went out of favor.
It's pretty crazy how value has gone through a lost decade. I was talking to someone who reached out to me about someone who ran an RIA, and he was calling me about potentially investing in my fund. And he was saying, I reached out to you because I just don't find a lot of people out there anymore who are actually doing value investing. And I'm a value investor. I know lots of other value investors. That's my world. But it kind of shocked me. But then I stepped back, and I realized there are so many people who closed up their funds, and there are so many value investors who, quote unquote, evolved and stopped buying stuff at 12 times earnings or 10 times earnings and started buying stuff at 25 times earnings because they were, quote unquote, great businesses. But it's funny the degree to which it's been absolutely killed.
Yeah.
As a strategy. It is killed.
Yeah, and I mean, it's done okay. I think like small cap value did 11% over the last decade, but compared to growth, I think growth did something like over 15%. Yeah. And then over a 20-year period, it works out. You get the cycle where growth has a lost decade, value does fine, and then you have another decade where value chugs along, but it doesn't do as well as growth. And like over the long term, it works. But yeah, you go through these periods where the factor is just out of favor and growth stocks are going bonkers. And yeah, if you're trying to stay in business, it's tough. I mean, investors are performance chasers, and they might say that they're long-term investors, but if you underperform for a couple years, they'll probably leave you. I mean, even if you look at Peter Lynch's fund back in the day, most investors lost money because they piled in after a hot streak and then got out after a little bit of underperformance, and that's the best performing mutual fund of all time. So just imagine if you go through a 10-year slog where things aren't going well, you're going to lose a lot of investors.
Oh, that's interesting about Peter Lynch. There was someone who won Morningstar's Mutual Fund Manager of the Decade. I think he won it in 2009. He ran the CGM Focus Fund. I can't remember his name, but he was the quote unquote the best mutual fund manager for a decade, and the average client lost money in the fund.
Yeah, I think I read about that. Greenblatt talks about that guy. I forget who it was, but yeah, it's a very similar
Bruce
story.
something.
Yeah,
Yes.
I forget. It takes a lot, but yeah, investors are fickle, and it's very difficult to find. Buffett has found a very loyal group in Berkshire Hathaway, and he can kind of ignore those periods where he underperforms. Like, he's not going to really lose any clients. But yeah, if you're trying to be an active value investor running a fund, you're going to lose clients during a period like this, and it's tough.
I'm curious, were you always attracted, even as a young person, to things that were deeply out of favor?
Yeah, I've always been a bit of a nerd. I've always been, if it was cool, I wasn't interested in it. I was always interested in to show me something off the beaten path. I'm kind of like a reflexive contrarian. Like, if someone says something, I'm thinking, well, how could that be? Trying to figure out how can that be wrong. It's always been kind of in my DNA.
It's interesting. I feel like a lot of value investors I talk to are that way. For me, I noticed even at a young age that people would dump on other people who were a little bit weird, or there was something a little bit different about them, whereas it didn't bother me as much. And I felt like those people were kind of discounted. And I felt that even at a young age. And so I guess that would be the first inkling I had that maybe I might be a value investor. I was attracted to stuff that other people weren't as interested in, and reflexively, just like you say.
Yeah, me too. And I mean, I've had a similar experience with, like, when I was younger with politics. Like, I'm not going to get into my political persuasions. It's changed over the years. But when I was younger, everybody in my family was of one political persuasion, and I immediately gravitated towards the opposite. That's just how I always have been.
And drove them crazy.
Yeah, yeah, I've always been like that. So
I have
I
a
don't know.
sister like that. She's very. I love her, but God, I just want to kill her sometimes.
I kind of grew out of that, but yeah, I've always been like that.
I actually appreciated one of your tweets recently where you were talking about how over time you've really become less political. I've gone through the same thing, and my wife has too. We were discussing this where we don't really believe either side anymore. We're
Hmm.
just kind of over it. It doesn't seem to lead anywhere. In order to be on one side, you have to believe lies about the other.
Hmm.
In order to be a liberal, you have to believe things that are really kind of bullshit about conservatives. And in order to be a conservative, you have to believe things about liberals that are just aren't the case. And it's funny, I've just grown exhausted, and I've seen that with a lot of people.
Yeah, I've gone through something similar. When I was younger, I would say from the ages of 18 through 30, I was extremely political, and then I started to wake up a little bit and realize, well, these things aren't entirely true. I've just been pounding them in my brain for 10, 15 years, 20 years really, and not a lot of it is 100% correct. And there's probably another side to this story. And politicians are constantly lying and trying to. The thing that bothers me most is how they always try to paint every issue, every election, as the most important thing that has ever happened in the history of humanity to rile everybody up, and it's really not that big of a deal.
It's exhausting. I didn't even vote this past election. My back hurt. I hurt my back doing something, and I just thought, screw it, I'm not going to go.
Yeah, and I mean, we have the privilege to say that in the United States, where our political structure, for everything wrong with it, is pretty stable, where we live in a pretty stable government. But yeah, our politicians are, and the cable networks are constantly trying to get in your brain and freak you out, and it's probably not worth freaking out about.
The interesting thing is that if you actually put, I think, liberals and conservatives, if you sort of put their back against a wall, the things they want are in many cases not that far apart. For instance, there's a lot of fighting over the size of the government, but do they really want that big a difference? I think today the government takes about 33% of GDP in taxes. If you look at state, local, and federal government. And so, what do most conservatives really want? They want that to be, 25%? They really aren't. There are not a lot that are looking for it to be that much below that. The libertarians, but they're tiny. That's a tiny percentage of the population. And then with liberals, they want it to be maybe 35%, maybe 40%.
Yeah, if you look at the track record, both of them are in favor of growing government. Even when you have the most conservative administrations, government still grows. Yeah, there really isn't much of a difference. And they're not even willing to tackle the two biggest areas of spending, which are Social Security and Medicare. There's almost no discussion of reforming it. And yeah, it just continues to grow.
It's interesting to me the degree to which neither cares about deficits anymore or debt levels. That is just completely, with Trump, that completely went away as an issue.
Yeah, they both pretend to be deficit hawks when they're out of power. Like, oh, these crazy people are spending so much money, and then they get in power and do the exact same thing. So, yeah, with deficits, I don't really think it's ever going to be no, we're never going to do anything about it until something is going wrong. And I have no idea what point that is. I'm sure there's some point where it's going to matter, but I have no idea when that's going to be. It's like trying to predict if you eat cheeseburgers every day, like what's the cheeseburger that's going to put you into a heart attack. So,
yeah, exactly.
It's hard to say like when that's going to happen, but who knows?
You wrote something once where you were saying whenever someone pitches you a stock as the next Netflix or the next Google or the next X, it's always a disaster. And I guess that's very interesting to me because my investment philosophy is built on really studying the past and trying to mine the past and figure out what are the most robust strategies that worked in the past. And what I find interesting is that assumes that basically the future is very similar to the past, and I think that is the case, but it's never the same. And it's amazing how I find what you wrote to be 100% the case. Whenever you are looking for something to repeat, you just get nailed.
Mm-hmm. Yeah, I think that's true. Yeah. Whenever something's pitched, for instance, like as the next Amazon, over the last 10 years, well, you probably would have been better off just buying Amazon.
Yeah.
Or it's the next Berkshire. Like I bought a stock I remember where the thesis was basically this is the next Berkshire. And it is not. It never quite works, and I would have been better off just buying Berkshire.
I'm just struck how you can't outsource your thinking. You can't just use an analogy to get out of looking at something for what it is. And I'm just struck by that, and not just in investing, but in all of life. I for instance, we hired an au pair a year ago, and it was a disaster. And there were red flags, but I was just sort of like, oh, the agency has such a good reputation. These people know what they're doing. It's always worked out before. And I was just ignoring the reality right in front of me. Mm-hmm. And I was outsourcing my judgment. And I guess I'm struck by how in life and in investing, whenever you outsource your judgment, you're setting yourself up for catastrophe.
Absolutely, yeah. You have to definitely look under the hood and figure out what's actually happening and can't just take a narrative. Now, narratives sell, but unless you're actually doing the work and doing the due diligence and proving if that's true or not, you're going to be in some trouble. And yeah, everybody has to do that research. Everybody has to figure that out for themselves. And oftentimes you'll find that the reality doesn't fit the narrative, which I think is what value investing is all about, finding the situations where that's the case.
Now with you're typically investing in these, what I would consider to be high percentage businesses. Is that a fair characterization? You want above average quality.
Yeah, I want businesses I can hold for a long time. So I had this transformation a couple years ago, there were a lot of things that prompted it, but a big thing that prompted it was COVID, where I actually was convinced we were headed into some kind of depression because of COVID, and I sold a lot of my very cyclical businesses. Like, there's no way this business is going to survive the economy getting shut down.
Hmm.
And that turned out to be the wrong case. And then I sat back and really thought about it, and I said, well, wouldn't it be nice to have a business where I could be confident that it could survive a nasty recession instead of speculating in all these cyclical situations and trying to catch them at the bottom and sell them at the top? Wouldn't it be nice to have something where I could be a little bit wrong in my timing and I could hold it for 5 years or 10 years and it could work out okay?
So for you, a quality business is one that basically has staying power and where there's a very high chance of survival.
Right, where if I'm buying at the peak in 2007 and we fall into the global financial crisis, where I can hold through the global financial crisis and not have to wonder, well, how deep is this going to get? How bad is the situation going to be? Where I can have some confidence that over a full economic cycle, this will probably work out. Now, with value investing, you're still trying to capture it at some kind of cyclical low, but as anyone who's been investing for a long time knows, that's nearly impossible to catch a bottom in a stock. So you need to own, in my opinion, you need to own quality assets where you can own them for a few years and be able to, it will be confident that you can make money through a full economic cycle.
Something I found was interesting is that you're looking for stuff where the shareholder yield, which is basically the dividend yield plus the buyback yield, is over 10%. Do I have that right?
Not necessarily over 10%, but yeah, shareholder yield is a key factor in what I'm looking for.
Mm-hmm.
I want to see buybacks plus dividends at a high rate. I think that's a major source of a shareholder's return. I'd say the dream kind of business I would like to own would be something where it basically grows at a fairly steady clip. It's not knocking the lights out, but it's growing at a fairly steady clip, and then it's generating so much free cash flow that they can pile that into dividends and buybacks, and much of the return can be predicted through the shareholder yield. That would be a wonderful situation.
So you're looking at something, and so it's not necessarily 10%, but you probably like that if you could find it. I would imagine that's really hard to find.
Yeah, that's impossible to find. I would love that. That would be the most amazing situation ever, if you could find a shareholder yield that high. But yeah, if a company is buying back a large percentage of the stock just through the laws of supply and demand over time, you're going to get a good return. Like a great example of that would probably be a stock like NVR, like a home builder. You would think of that as a terrible cyclical business, but they've bought back a third of their stock in the last 10 years, and the stock has responded to that. Or Dillard's, which is not a great business, but they bought back so much stock and restricted the supply of it that you had a wonderful effect a couple years ago.
Dillard's. What is Dillard's?
That's a retailer.
Okay.
Yeah,
I'm from South Dakota originally. I grew up there, and then my parents moved to Connecticut when I was in middle school, and I would go back there all the time. That sounds like, I feel like that is in South Dakota. Is it in the Midwest?
I forget. I think it was based in Texas, I want to say.
Okay.
I owned it many moons ago. But yeah, that's a stock that has worked out tremendously since COVID, and they had been buying back stock for years, and the stock wasn't responding, and then eventually it just kind of hit a peak. It hit a peak mass where the stock blew up once a lot of that was already happening.
But it's interesting. So you really want something where you don't need someone to come in and save you at a higher valuation, where basically the company, they're either, well, you didn't mention how much they're growing, say how much they're growing top line, but where through giving back capital, either through dividends or buybacks, they're increasing the intrinsic value, at least per share of the business, by some rate every year, no matter what.
Yeah, and growth is a wonderful thing. I don't want to say I'm not looking for growth. I absolutely would like top line growth, but I think there's a lot of factors that go into it, and a key one is that shareholder yield that can really boost your returns. And yeah, you don't want to buy. It's tough to buy these situations where you're like, I'm going to buy it at a PE of 5 and sell it at a PE of 10. Those never really, I've never really been able to get that to work out for me. So yeah, I'm not looking for a savior. I'm not looking for like a private equity firm to buy it out. I'm looking for something where it's a good business. They're buying back stock. They're issuing dividends. They're not going to get disrupted in the next 5 years. I'm getting it at a decent price. It might not be the lowest it's ever going to be, but I think that situation, given enough time, it should work.
When you bought lower quality stuff at 5 times earnings or whatever, did you notice something typically happening that made it not work out, or was it just random? There was just always something that just made it not work out for you.
Well, statistically, if you do the back testing, that strategy is better than buying quality businesses. But the problem is when you're getting into the weeds of some of these stocks, it's always easy to find a reason to sell, especially when you take into account macro considerations. In a lot of
Mm-hmm.
my experiences buying these things, you're buying it for hopefully you're hoping mean reversion will take place in the business, that it's in a tough situation right now, but it's going to pick back up. But I don't know, I've just never been able to find it to work out for me where I'm buying it at the right cyclical low. I bought some energy stocks in 2015 thinking, oh, energy just got crushed. That's probably going to come back, and it didn't. Um, I bought some mall retailers thinking, well, sentiment has probably reached an extreme and the market's throwing out the baby with the bathwater. And no, the mall retailer just continued to get crushed. Like some of the things I bought were like Francesca's, Express, um, which
Oh,
I think
Express.
I think that later turned into a meme stock, but I just got annihilated in it. So yeah, I've never been able to quite get it to work. I think the way to do that is to do it in a quantitative kind of way where you're buying
Mm-hmm.
30 stocks and just holding your nose and not really looking too deeply at the fundamentals. You're buying a portfolio based on the quantitative metrics. But for an individual investor like myself, at that point, I might as well go out and buy like a small cap value ETF and probably get a very similar result.
Yeah, interesting. I'm curious. I feel like a lot of your philosophy, just from looking at your Substack and looking at your tweets, is really just about being reasonable. And do you feel like that's the case too? You're just trying to do the reasonable thing.
Yeah, I think if you look at Munger and Buffett's success, I think a big part of it, yes, they found great investments, and yes, they applied some leverage to them, and yes, they're incredible business analysts. But a major reason for their success is that they avoided a lot of these fads, and they were able to stay sober when insane things were going on and not participate in all of these different bubbles. And I think if you can just do that, if you can just stay sober for 30, 40 years, you'll have a pretty good result.
How do you think they did that? I'm amazed the degree to which they've avoided losers.
Yeah, I mean, it's incredible. Like, you have to figure late 60s, early 70s, they were getting pressure to buy Nifty 50 sort of stocks. Meanwhile, Buffett's closing his partnership and saying, I don't understand what's going on with the market right now. I'm sure from just a this isn't more of an investing thing, but more of a reputational thing. I'm sure Buffett had a tremendous temptation to participate in the corporate rating of the 1980s, and he realized that that would damage his reputation and didn't participate in that. He could have been out there liquidating big companies and doing stuff like T. Boone Pickens and Carl Icahn, but he didn't do it because he wanted to maintain his reputation as I'm a guy that you can do business with, and I'm not going to destroy your company. They didn't get swept up in the internet bubble. They didn't even get swept up in overpaying for big businesses in the last 10 years. You know, you would have thought that they would have gone out and really paid up for some things. And there haven't really been many circumstances where they did that. The one tech company they did buy, they bought it when it was 10x EV/EBIT, Apple in 2016. So they've just always been able to stay sober in the midst of probably tremendous pressure to participate in the fads of the day.
Yeah, I'm also just stunned by how many people have tried to copy that. You look at what's his name? But there are two people. There are two hedge fund guys who created reinsurance firms and tried to create mini Berkshires, and it didn't work at all. Gotham tried to do it, and I can't remember the other one. Dan Loeb, I think, tried to do it, and I don't know how Dan Loeb's turned out, but the other one didn't turn out well at all. It was a disaster, as I recall.
Yeah, it's just a hard thing to duplicate. It sounds easy on paper when you read about a lot of what they did, but it's an incredible genius that went into it.
It's also just interesting how they made the leverage work, because if you look at I think a lot of people know this by now. Berkshire is typically run at 1.6 to 1 levered, and at times they've been 2 to 1. I was looking at some of their old balance sheets from the early 80s, and they were 2 to 1 levered.
Wow.
And it's interesting. That would suggest not the 2 to 1, the 1.6 to 1. That basically that turns a 13% return into a 20% return, which would suggest, markets typically return 10%, and they return 20%. That basically 2/3 of their alpha came from leverage.
Yeah, and it's for a lot of investors, once they start experimenting with leverage, it's kind of like drugs, like or eating potato chips or something, like where you do a little bit of it and you're like, what about more? Wouldn't that be better?
Yeah.
And they've always been able to have the discipline to use leverage but not get too crazy with it, and then apply it in the right situations.
I mean, they almost figured out a way to get rid of the path dependency of leverage. It's kind of shocking how much they made it work for them.
Yeah, it really is. They're amazing, brilliant guys, no doubt about it. I don't know if we'll ever see anything like it ever again in business history.
I was talking with Bill Brewster about this months ago, and he was saying when they die, he's going to be as sad as he will be when his parents die. They mean so much to him. They're like, they mean, not as much as his parents, but close to it. I'm curious, do you feel the same way? Do you feel that deep personal connection with them, or are you just more interested in the investment stuff?
No, I have the same kind of personal thing with them. I've learned so much from Buffett, reading his letter, listening to him at the meetings. I've never met him, but I feel like I've learned so much from the two of them. Yeah, it will absolutely be sad when they're gone.
My dad had a friend growing up when we were in South Dakota. He worked for the South Dakota Investment Council, and he named his son Graham Buffett, last name. It was.
Oh wow!
People really love these guys. This is he named his son this in the 80s.
That's amazing.
People love these guys. I love them too. There's something about them where it's not just about making money. They stand for something, and I think that really resonates with people.
Yeah, they stand for doing. They show that business can be done in a ethical kind of way, and it's a testament to their character. Like they've been able to resist doing so many foolish, unethical things over the years. It's really just incredible. They've never given in. They've never done anything that's unethical or underhanded. They've always made sure that we're going to maintain our reputation, and we're going to be ethical people, and we're going to be good people to do business with, and that's worth more than some short-term thing that we can exploit by being unethical. It's amazing.
Returning to at least what I see is your focus on trying to be reasonable and avoiding bubbles and avoiding stupid things. Do you think life is about going for big payoffs, or is it about not doing stupid shit?
I think it's about not doing stupid shit. I'm 100% on board with that. Slow and steady wins the race. I'm 100% on board with that. Like a lot of the times you'll see people, we're seeing a lot of that right now, where people will try to get rich quick, and it inevitably blows up in their face. And I think if you have a disciplined approach, I mean, just for the personal investor, if you're out there chasing every single fad that's coming along, like you're buying .com stocks in the late 90s, you're flipping condos in the 2000s, you're getting into crypto now, Like, if you're doing that, you're never going to get ahead if you're constantly trying to get rich. But if you have some guy who is slow and steady, investing a steady percentage into his 401k that goes into some index funds, that guy is going to be rich in 20 years. And it might take a long time. It might be a lot of hard work. It might not be super exciting. But that's definitely a better path than trying to chase fads and get rich in a couple years.
On that point, my favorite investment book is The Great Depression: A Diary. It's a book by Ben Roth. It's not very popular, but he was an attorney in Ohio, and he lived through the Great Depression and kept basically a financial diary, documenting what stocks were doing, what preferred stocks were doing, bonds. He has it all written down, and he's capturing the mood of the day. And it's interesting, at the end of the Great Depression, he's reflecting on what worked and what didn't. And he's saying, when I think about all the forecasts that the great economists made, I have to laugh because they were all wrong. Mm-hmm. And even his own predictions about, he thought FDR took the country off the gold standard. There was some bad inflation, but then Roth, the author, thought that there'd be hyperinflation, and it never materialized. Mm-hmm. And he was talking about how basically the only people he knew who had any success in the stock market were people who just had some way of determining a stock's intrinsic value, mm-hmm. and they just bought when it was well below that, and then they didn't do anything else. That's it.
Yeah, that's 100% true. I've gotten involved in macro trying to predict what happens next, and I've given up on it. It's impossible to do. I thought we were going to have hyperinflation in the early 2010s. I thought COVID was going to be a depression.
Me too. Me too. I thought all that too. I was convinced.
Yeah, and it never works out the way you think it will. So yeah, it's probably a waste of time. I think a good person to think of with all that is John Maynard Keynes. He was a macro speculator in the 1920s. And then he eventually gave up on it and said, I'm going to buy good businesses at good prices. And then that's the strategy that wound up working. Great, one of the greatest macroeconomists of all time admitted he couldn't predict macro and simply tried value investing, and that worked out for him.
I'm familiar with that and love that story. I think it kind of says it all. It's the fact that this guy is so clever, thinks about it so much, and is such an intellectual heavyweight even today. His economic thinking probably sways people more than any other mm-hmm. today. And the fact that he couldn't make it work suggests that it is really, really hard and low percentage.
Yeah, I think it's impossible. And I think a lot of the people that you find who are great macro traders, it's difficult to say when you're talking about like the markets being a coin flipping contest, if they're the one out of 10,000 monkeys in a coin flipping contest that won the game. It's really, and so many of them can never duplicate it after they make this wild macro call. The next one inevitably doesn't work out. So yeah, I think it's foolish to try to think that you can predict macro. I tried it for a long time, and eventually I admitted defeat. It can't be done.
The one place where I think the funny thing about macro and the reason it captures our imaginations is because it's constantly presenting this existential risk mm-hmm. to your wealth. What's going on in a country? If a country collapses, it's like what happened with Germany in 1929. Or what happened in Germany after World War I, which set the conditions, unfortunately, for the rise of the Nazis in World War II. But what went on there was insane. But avoiding things like that, I think there's something sensible to that. Unfortunately, that's a 1 in 50-year occurrence, let's say. Maybe a 1 in 100-year occurrence. And so I feel like the times when macro would actually add value, where you're avoiding a country that's undergoing collapse. I get why it captures our imagination. It's just there's never the opportunity for that fear to pay off, because we're constantly scared for something that happens 1 out of 100 years, and it just doesn't happen often enough to be worth it. What do you make of that?
Yeah, I think that's probably true. You definitely want to avoid a situation where markets went to zero, which would be the situation in Russia in 1917 or China during the revolution. You would definitely want to avoid those situations where markets go to zero. There are probably ways to diversify have a reasonable portfolio where you diversify away from that, own stocks in multiple countries, be internationally diversified, have some real assets like gold, not a huge percentage, but yeah, you could have a percentage of that in your portfolio and preserve some of your wealth. There are probably ways to avoid that, but at the same time, if the United States is going down, the world has some serious problems. I'm not sure if there's going to be any place to hide. So,
Right.
if the
But
existential risk is that the U.S. has hyperinflation, the dollar collapses, and that the U.S. military can no longer be financed, well, the entire world is going to hell at that point.
no, you have done a lot of work on this with your weird portfolio, I believe you call it, where you're basically. Well, why don't you? Why don't I let you discuss it? Can you explain it for everyone?
Yeah, so with a lot of these struggles I've had with picking stocks, with trying to predict macro, um, I wanted a portfolio that was passive that I could pile my savings into and pursue financial independence with. I didn't want to just do the S&P 500 because I do have those macro jitters every now and then where I'm worried about hyperinflation, I'm worried about the country falling apart. So I wanted to design a portfolio where um, I could have a passive asset allocation, not try to predict anything, and feel confident as I piled my savings into it. And it's basically internationally diversified value, internationally diversified REITs, long term treasuries, and gold. And the goal of that portfolio is to preserve wealth, limit volatility, and then avoid large cap financial bubbles.
See, that's very interesting. So, would you say most of it is? Well, actually, let me take a step back. I've long thought that there's something. If you go around the world and you look at equity markets in virtually any country, you see that they almost to a letter over 10-year plus periods they earn 8 to 10% a year.
Mm-hmm.
It's almost like gravity, where it's very hard to extract more from an equity market than 8 to 10% a year. And the only times when that doesn't happen is when it gets either extremely overvalued in a bubble or extremely undervalued. But those are very rare events. I'm curious. So, is your approach basically you're kind of saying, look, I want to be invested in equities, but I want to avoid bubbles and really kind of get that 8 to 10% in the most robust, high percentage way?
Yeah, and pivoting to small cap value, I think, is a good way to do that. Small cap value kind of grinds out a return decade after decade in every market. It's
Mm-hmm.
never going to be outstanding performance like when you're in a growth bubble, but it basically grinds out that 10% return decade after decade. Even in Japan, small cap value has worked since their bubble collapsed. So my thought was, well, if I pivot to small cap value and diversify that internationally, first of all, every country in the world isn't going to enter a bubble at once.
Mm-hmm.
Small cap value, just by its very nature, is going to avoid large cap bubbles. It's not going to participate in them, and it should still be able to grind out and sustain a high rate of return. And then I wanted to add some diversifying assets to that because I do worry about inflation. Sorry about that.
Oh, no worries.
I do worry about inflation, so I wanted some real assets like real estate and gold in there. And then treasuries. Treasuries have that effect where when you're in a global financial crisis, they tend to do very well and limit your losses. And it was really inspired by Harry Brown's permanent portfolio, which is a
Mm-hmm.
similar kind of structure where it's 25% stocks, 25% cash, 25% long term treasuries, 25% gold. And that's a portfolio that has done extremely well over time with limited volatility. A lot of it was inspired to that, but by that, and I wanted to have add my own twist on it where I'm pivoting to value, I'm diversifying it internationally, I'm having less cash so I could hopefully have a higher rate of return.
Are you using you're adding REITs to the mix?
Mm-hmm.
Are you using those to kind of be a bond replacement because bond yields got so low, or what's the impetus behind that?
REITs are more about inflation, so inflation protection. So
Okay.
presumably, if we're entering a period of high inflation like the 1970s, real estate should keep up with those values, and rents will also increase with that. Historically, if you backtest it, REITs have basically outperformed the market. REITs also did extremely well during the 1970s. they don't do well. They aren't a bond replacement in a period like 2007, 2009, 1973, 74. They're going to suffer in a recession. But if you're in one of those decades where inflation is sustained and it's high, REIT should do okay.
Okay, interesting. Do you feel like 90% of investing is avoiding bubbles?
Yeah, I think that's a huge part of it. I think if you just stay away from them, you can have a pretty good result. If you stay away from these bubble fads, you should have a better result over time. And if you can just avoid that stuff, you'll grind out a return decade after decade, and that compounds, and you'll have a good result in the end.
I also, before I forget, I wanted to ask you about crypto. What do you? You're not a fan.
Mm-hmm. Yeah.
What do you? I'm not a crypto guy. I don't really have an opinion one way or another. I have no idea what to make of it. It seems like it could have some use. It seems at the same time it's certainly not needed. But what do you make of everyone, of all this money chasing crypto and all these intelligent people investing in FTX?
I've always thought crypto was nonsense, so I missed the bull run, but I also don't get my face ripped off when it has one of these horrible bear markets. Why am I a skeptic? So first of all, I don't think it fills the medium of exchange as a currency.
Mm-hmm.
I just don't buy it. Something that volatile cannot be used as a currency. If I was to make a deal with you and say we were going to work on some project together and I said I was going to pay you X in dollars, well, that's a deal we can put together and you can be confident that the dollars might be worth a little bit less a year from now, but basically it's going to maintain that value. How do you do something like that when it's something that can go from 8K to 20K and 60K down to 20K? Like it's just so wild, unpredictable, and volatile that I don't think that works.
Sorry, go ahead.
So I mean, that's the media. It's not a medium of exchange. Second thing is, it's all driven by this hatred of the Fed, which I can understand. I mean, the Fed has made a lot of mistakes, but at the same time, if you look at the history of the United States prior to central banks, it wasn't exactly better. We basically we had more stable currency, but we went through bigger extremes. The economic cycle was more extreme. You'd have, during a boom, you'd have high inflation. During a recession, you'd have a period of deflation. The inflation and the deflation would exacerbate the whole cycle. If prices are going down, you're going to hold out to spend your money. You're going to say, oh, I'll wait until next year and prices will get lower. Well, that makes an economic decline even worse. You had panics that crippled the nation, like the Panic of 1907, which is why we set up the Fed in the first place. So for all the things that the Fed does wrong, I think that the Fed does a decent job, and I do think it's healthy to have a little bit of inflation. So I disagree with that whole aspect of it, that we want to eliminate the Fed. I don't think that's going to really work. And then finally, the idea that the dollar isn't backed by anything and fiat is worthless. I don't agree with that either. I think that the Fed is backed by something. It's backed by a lot of guns and nuclear weapons and aircraft carriers, and there's something backing up that value of the dollar. We might have a little bit of inflation every year, but it's not the end of the world.
Right. It's backed by a lot of Americans who are ready to kick some ass.
Right. And then on top of it all, everything about crypto it reminds me of every single bubble in history. Just the way people talk about it, the way people act about it, the way that they're chasing these prices. Every alarm bell in my brain that I've ever set up from studying bubbles is tripped with crypto. It's like, this is 100% the type of thing you need to avoid. So that's my stance on it.
Yeah, that's interesting. That was something that struck me early on, which is that in terms of a medium for exchange, people just weren't using it more for its intended use. They were just speculating in it.
Yeah, and it worked out for a brief period of time, but I think in the end people chase prices, and that's the story of crypto.
Yeah. The thing, I guess, here's my theory. I think there's a very real chance that it becomes this kind of third way, this kind of third rail. And it just becomes this obscure thing. But then but then maybe every once in a while, some country will start confiscating wealth and people will pile into it to get their assets out. And basically it just exists as this opt-out. And it doesn't replace everything. It's just kind of there as basically a great opt-out. And I guess there are two really, for me it only has two uses. One, the government, all democracies run deficits. They're all slightly inflationary because people want a little bit more than they can afford. Sometimes they want a lot more than they can afford, and they put their societies at risk. But most of the time, we just want a little bit more than we can afford. And we just kind of cheat it. We put our thumb on the scale and say, you know what, we'll just run at a little bit of inflation. We'll just steal from ourselves just a little bit to cover it. Mm-hmm. And then at other times, you have full-on confiscation, where a country is just overriding private ownership. And crypto is a way out of that. I don't know how you're going to get your body out of the country, but it allows you to get your financial assets out of the country. And so I guess, I don't know. I don't want to carry water for crypto at all. Mm-hmm. But that to me seems like the most likely outcome, where it's just kind of this obscure thing that exists every once in a while, or becomes useful once in a while.
Maybe. Yeah, I tend to think that the U.S. government will eventually shut it down. And I think that's all it takes, is like the U.S. government to say it's illegal to own this. And I think that's probably going to happen at some point, when we wind up going to war with a rogue nation, or we have a major terrorist attack, and then it comes to light that, oh, they've been moving money around the world with crypto. Like, I think a major reason we haven't had a major terrorist attack since 9/11 is because of all the capital controls that the U.S. government put in place to make it really hard to move money around the world. And crypto basically circumvents all of that. So I'm pretty sure whenever we face the next conflict or the next terrorist attack, it's going to come to light that they move the money around with crypto, and then I think the U.S. government shuts it down.
Mm-hmm. Mm-hmm. Yeah, it's interesting the degree to which the U.S. government has control over money worldwide. I really wish they seized Russia's assets, dollar reserves that were overseas. I agree with you. I think it's terrific that we have all these ways to combat terrorism and things like that. I really wish the U.S. government wouldn't push the envelope on that quite so hard, where they seize the reserves with Russia and are doing these things that are really aggressive, that make other countries want to de-dollarize. Because I feel like we're kind of pricing ourselves out of this wonderful privilege that we have.
Yeah, we could screw it up. That's absolutely true. But at the moment, it doesn't seem to matter. It seems like they can throw their weight around and get away with it, and there's no real consequences to it. Will that last forever? I have no idea. But yeah, I do think that they could pass a bill tomorrow that could end crypto. They could say it's illegal to own it. They did it with gold in the 1930s. They could absolutely do it with crypto, where you can't spend this here. If you're caught owning it, you're in some type of trouble, and they could end it all tomorrow.
Yeah.
All they need is the incentive.
Yeah, as I recall, in the 30s, I think they also were shaming people. They were doing something where they would put you on a list if you were caught owning gold, or they threatened to do it. They didn't do it, but they threatened to do it. Where you'd go on a list and you'd be shamed as a gold hoarder.
Yeah,
it's interesting, but I just wanted to wrap up with one thing. Your favorite movie is The Neverending Story. What do you love about it?
It's not
or your favorite childhood movie.
My favorite childhood movie. There you go. Yeah.
Yeah. Sorry about that.
No, that's okay. Yeah, I grew up watching that movie. It's just a wonderful. I rewatched recently. It's a wonderful movie. It's very imaginative. It's also wild. There's also things in that where I'm shocked that they showed it to children and thought this was an appropriate children's movie, where, like, when Artax drowns and he just dies.
Wait, what happens with that? Who's Artax?
Artax is Atreyu's horse, and there's this scene where he's going through this thing called the swamps of sadness, where basically as you get depressed, you sink into this swamp. And Atreyu is pleading with his horse, please don't drown, fight the sadness. And then the next scene, the horse is dead. Like, it's wild that they thought that this was
I could you imagine if they put that in a kids movie today? The outcry that would happen.
Oh, there is some crazy stuff. That movie, the wolf in that movie, scared the shit out of me as a kid. I rewatched the movie a year ago. It was pretty freaky.
Yeah, me too. It's very trippy. It's almost like it must have been drug induced or something. Some of the things that are that are in that. Like, who thought of this? This is a wild. This is a wild imaginative movie.
I love stuff like that. I love when someone makes something for kids and then uses that as license to just let their imagination run hog shit wild, and it goes to some crazy place. I don't know if you've ever seen Return to Oz. It's it's the sequel to The Wizard of Oz.
Hmm.
It
I've
is
never
a
seen it. No, I've heard of it.
oh, you got to see it. It's a terrible movie, but it is like it's like hallucinating on drugs. It's sickening. I can't believe people ever showed it to kids. Kids would just start. I almost lost my mind watching this thing. It's really dark. It's really freaky.
I'll have to check it out.
But the Neverending Story is actually has a nice story to it. It's nothing like Return to Oz.
Yeah, I rewatched it, and I was impressed that it held up. I was a little worried when I rewatched it that, well, maybe this won't hold up as well as it did when I was 4 years old, but I thought it was still a pretty good movie.
Yeah, I think it's very good. Well, listen, I really wanted to thank you for coming on. I've really enjoyed your Twitter account for some time and your Substack articles. It's been great having you on here. I'd love to have you on again sometime.
Yeah, thank you. Thanks for having me. It was a blast.
With that, it's a good place to end. Thank you, and
Awesome. Take care.